Hello, you are watching the Short Vol Show live on YouTube, and my name is David Lincoln, and I am your host today. So, welcome to the show. If you're new here, thanks for watching. I believe I probably picked up some new people due to the Steve Burns interview and other people finding me on Twitter and whatnot. If you are new here, just to give you a kind of idea of what this show is about, I'm here to help you make money, inspire you, give you some new ideas, give you a new attitude. But most of all, give you some extra tools to help you make money in this market and in your personal finances in general. I guess I'm most known for talking about the VIX, the quote unquote fear gauge of the market, but I was a trader for many years. I was a floor trader. I stood there with a colored jacket and yelled at people. Here's my colored jacket. And I would sit there and I yelled at people for a living, and it was lots of fun, and made money as a professional options market maker. So what we're doing today is I want to talk a little bit about where we are in the market, and I want to ask you about what your year has been like so far and kind of what your strategies are. I think not all the time, but from time to time we need to back up and reevaluate what our strategies are as far as with our finances, whether that be short-term, medium-term, or long-term. We need to go recheck our plan. Now, as far as long-term, let's talk about that first. Long-term might be, well, you may have nothing, and that's fine. Most people have nothing saved. But if you have nothing, I am here to encourage you to start saving and start putting money away. It'll make you feel better. Reason number one, it'll make you feel better if you have a little money socked away. But let's say, for example, though, that you do have some savings. You most likely have maybe a 401k with your company. Maybe you have an investment advisor that watches your family's stuff. Maybe you have a stockbroker. Maybe you own mutual funds. Many of us, though, have long-term investments. And if you don't have long-term investments, I would suggest to you that what that might look like and what you might start to aim for is having your money somehow mixed between being in a savings account, okay, which could be under your bed. I don't really recommend that because you don't want to risk it getting stolen by somebody or something. But savings account can give you a little bit of interest on your money, but more importantly than that, it's a spot where you can save money. It's safe. It's away from harm's way of getting robbed from you or something, and you can build up your money. Most people in this investment industry would recommend you having your long-term savings in something like stocks and bonds, some sort of mixture of stocks and bonds. Now, stocks would be a more risky investment than bonds in many cases, but also stocks would give you a higher potential of increasing what you have saved. But the most important thing for everybody to start with is to start saving money. I would not be focused on, this investment versus that investment until you have it down that you can save money every month, every week, out of every paycheck in some way. And the easiest way to usually do that is to have a savings plan through your company, a 401k maybe. Many companies match your savings in a 401k. And I know some people are listening to this are going to say, Dave, this is all obvious. This is too simple for me. But I guarantee that you at least know many people around you who don't have savings and who don't save money and who live maybe check to check, or say that, well, I don't make enough money to be able to save money. That is a question of priorities. You owe it to your family. You owe it to your kids if you have kids to start saving money. We need to make some sacrifices today so that tomorrow can be better for us, for the future. So as I said before, many of us have some sort of setup, and maybe your parents helped you do it. Maybe somebody else helped you do it, but you want to check it out and see what it is and what your holdings are at some point. I would say a good thing to do if you don't have this would be to go and buy something like the SPY, the SPY. It's an ETF. It's going to give you ownership in a large number of stocks that represent the U.S. market. So U.S. market goes up, you make money. That is my suggestion to you. If you have a company 401k, I would recommend finding out if your company matches, and if the company says, "Well, we match up to 5% or something like that," do it. It's free money. It's like 100% return. Also, if you have credit card debt, that might be the first thing you want to do is get rid of that before you do savings. And I know it's tempting to say, well, let me do both. I'm gonna start my investments, and on the side, I'm also going to start to pay off my credit cards. But you need to think of it as whatever your credit card payment, whatever your credit card interest is, by paying it off, you're actually automatically giving your money that much in benefit. So if you're paying 20% per month or 20% per year for credit card debt, paying that off is actually giving you 20% return on your money guaranteed. So you need to pay that stuff off. And I know it's not fun. But you know what? This is not about fun. It can be about feeling good about yourself. It can be about doing good things, but finance is not about fun. It's a very serious thing, talking about your own personal finance. And, but it will be fun once you don't have any more credit card debt and things are going better for you. So take some steps to get yourself situated and in a good spot. One of the best things you might be able to do for yourself would be to get a better job or a second job. All right, so let's talk short term for a second. Okay, so you have, maybe you do or you don't have a long-term plan for your retirement or your future. Let's talk now just about your trading account and this year's trading. Now I'm talking to you out there who are participating in the market, which should be a lot of people that are watching this video. Okay, you have a trading account. Maybe you're buying or selling stocks. You're buying and selling options, and varying levels of sophistication. It makes sense to me to take stock of what you're doing, and it might make sense for you to take a little bit of time off. Are you in there? I know there will be some of you who are in illiquid positions where it would cost you money to take them off, but the majority of you could kind of like reset things, start over, and move all your money into cash and reevaluate for a little bit. My focus a lot of the time has been to manage my risk by, I spend most of my time worrying about ways that I could possibly lose the money I have. And when I don't have any positions on, then there's no worry about losing the money I have. And you might consider, well, let's take 3 cases, okay? Case number 1, you've made money this year since January 1st. Your account's up money. That's great. Did you make money last year? Did you make money the year before? If you're up money and you haven't been up money in the past a lot, might not be a bad idea just to take off your positions, hold on to your cash. You're sitting there, you could roll through the rest of the year and say, I had a profitable year and my money's safe. It's in cash. A. B. Having money in cash is a huge thing because it allows you to jump in when there's an opportunity, okay? You already may have your brokerage account set up. You're already trading this stuff. Your money's on cash on the sideline, okay? Now, there's always new trades out there that are exciting, and you are in the perfect position to take advantage if your money is in cash. Those of you who have been playing this game for a while, you might know that when you're trying to put money in your brokerage account, it takes days for it to clear. It takes like 5 days for it to clear, so you're ready to trade for options, for example. Well, if you go to cash right now, your money's ready to trade right away. And it might be, who knows, tomorrow the market might crash. And if you're in cash, you are in the unique opportunity to buy the bottom if it crashes. But more likely than that, an opportunity will present itself soon enough. It's a good mental exercise. It's kind of like spring cleaning when you clean out your closets, to take off your positions, go to cash, and sit there in cash. Now, some of you I know are day traders, and you go to cash at the end of every day. But for me, I'm a position trader, so I very, very seldom do not have some risk on one way or another. So for me, it's going to be a great way of cleaning things out to just go to cash. So consider that. I've been working to try to make these episodes more of a sort of podcasty style. I'm going to be offering them on the various podcast sites so that you could listen to me if you're in the car driving or at some other place where you don't have to look at the video necessarily. I like to point out stuff with the video charts and things like that at times, but I'm designing these episodes so that you can get pretty much just as much enjoyment out of them if you're just listening to them in podcasts right now. Because I noticed there's not podcasts about the VIX out there really. There's maybe one. And it's a spot that I can come into and provide some value, which is a good feeling. So, we're at a spot where the market just really has made this huge move. Who could have guessed in December? Remember in December we had the Fed coming out and raise rates, even though the market seemed to be selling off, and everybody's like, oh, the market's been down the last couple of days. Why are they raising rates? And then the market went lower, and they started to say, oh, the economy. It was like everybody was doom and gloom, and things turned around, and since then, they've gone back to all-time highs. I mean, the market has had a huge rally. I was looking at, I Googled 3 times leveraged ETFs, and I was thinking, if I had just had money on the side, or I do this a lot, and I'm sure I'm not unique in doing this, is that I look back in time and say, oh, if I only done this or that. And I don't want to spend too much time dwelling on the what-ifs from the past that I can't change, but I spend a little bit of time on it. And I pulled up this site and had the top 105 3 times leveraged ETFs. And, I mean, you could have bought a leveraged ETF that was long the market, like the TQQ, or the UPRO. There's a whole bunch of them, and they're up like 60% since December. I mean, you could be up huge money if you just gotten along the market in December in a leveraged way, or even in a non-leveraged way. If you just bought Apple, for example, in December, you would be up huge. And I always find that interesting when, like, you could have made one trade, bought the TQQQ, and you would have done better than all this jockeying for position back and forth with options and churning your account and all these things. Let's look at UPRO, or let's see, UPRO. UPRO's 54 right now, and back in December, it was quite a bit lower. You know, it's funny, I took the cord for my second monitor somewhere. I think I took it to my folks' house to watch Game of Thrones, and it's still there. So I only have one monitor to work with today. So makes things a little bit harder for the little podcast here. But yes, okay, so there was a low in December on UPRO, which is a S&P leverage ETF. It was down to 28. Now it's 54. So it's essentially doubled since then. So you would have doubled your money in less than half a year. What a great trade that would have been. TQQQ, same thing. ProShares Ultra Pro QQQ ETF. It went from 30 to 67. Boom. Wow. Now this one hasn't reached the high it got to is 73, so it still hasn't reached the high, but still, wow, what a move. Now you should know with a triple leveraged ETF, if it says it's going to do 3 times what the regular futures thing does, you should know that it's not going to be able to obtain that. It will To the downside, it will do a little bit more than 3 times, and to the upside, it'll do a little bit less than 3 times, because these leveraged ETFs, they do have a little bit of drift, as due to the formula, they have to buy futures to rebalance and sell futures to rebalance, and that process usually results in a little bit of quote-unquote negative scalping, which means that they perform slightly less than you think they're going to every time. But still okay, okay, big deal. So instead of this going from 30 to 70, it went from 30 to 67. But still, if you could have just recognized in December, when it was all that doom and gloom and the end of the world, if you could have recognized, wow, there's a ton of negative sentiment out here, and bought, then you would have done great. So for me, in my mind, I have to have a little placeholder in my mind, so that if this kind of thing happens again, I can think that way, possibly. Now, nobody says it's going to happen exactly like that again, but we do know when things are down, that's a buying opportunity. So right here, where we're, approaching the highs, bouncing off the highs, it seems like it's probably not the best time to get long. Now, things could go straight up from here forever and ever and ever, and if you didn't buy it here, you would have missed out. But that being said, I tend to at least wait for somewhat of a pullback before I buy something. So that brings us to the dilemma, just to get back to the VIX here. The VIX right now is exactly 13. 13 is pretty low in the grand scheme of things, right? So if you are watching this, I'm going to attempt to put up some visuals for you to look at here. 13 is, now 13 is high if you're looking at 2017, but just in general, pretty low as far as the VIX is concerned. So let's switch over to a little bit of a view of the charts here for you. And here we go. All right, so here's the VIX, and 13 looks really low. It looks like it could launch from here. We saw that spike in December up to 36. However, we see back at, if we look before October, we see an extended period of when it was like between 12 and 14. And indeed, it spends a lot of time historically in that section between like 12 and 13, maybe 10 and 13. And so it's perfectly possible that we can stay in this low band. And I would say it's almost likely that we would stay in this low band with the VIX for a period of time. So it creates a quagmire, because if you're selling VIX ETFs, it feels like, okay, you're selling at a very low spot. And so that seems like it could be a little bit too aggressive. But if you're looking to buy VIX ETFs, I generally never do that, just because of the decay involved. So I'm getting into a little bit more specific stuff that I'm talking about right now. So let me just define a couple terms. Okay, the VIX is the SIBO Volatility Index. It sort of oscillates between, let's say, 10 and, well, it can go up to the moon, but generally between 10 and like 20, maybe 10 and 30. I think the all-time average is actually a little bit higher. The all-time average is about, I think it's about 18. Might be as high as 20, depending on how you calculate that. But the VIX just kind of goes up and down. So you could say that 13 would be kind of a buy because it's on the low side. However, there is no way to buy the VIX. You have to buy VIX futures, and those are a whole different ball game. VIX futures and VIX ETFs like UVXY are a whole different ball game, because they don't oscillate up and down. They basically just go down. It can take time for them to go down, but they slowly over time go down. So to catch a pop on it when it goes up, you have to time it right. And I wouldn't say you have to time it perfect, but you have to time it right. So if you were to buy, UVXY right now is around 32. If you were to buy it here, you could slowly creep down from 32 for a while before you get that pop you need. Now, depends on how much of a pop you want. We could never see 32 again. Right now, UVXY is 32. We could never see 32 again, but the chances are that it will pop through to 32 again at some point. And there's definitely kind of more of a case to be buying a UVXY right now than there is to be selling one. That being said, people that are committed to the short vol trade will short it here, and they are just looking at a longer time horizon than the shorts are. If you're looking out at a long enough time horizon, then selling UVXY at any price makes sense because it's ultimately going to go lower. So those who are buying UVXY right now are looking at a shorter time horizon than those that are selling it. And that, if you assume people are kind of being rational about what they do, that's what you have. The buyers are looking for a pop at some point. They're looking, if you're a buyer of UVXY right now, you're saying the VIX is low from where it has been this year. In fact, it's spent a lot of this year up around like 24, 26. It's low from where it was. We could see it. It's kind of a mean retracement trade. People a lot of times will trade something and say, well, it usually is around this price. And so if it's lower than that price, then you buy it. If it's higher than that price, then you sell it. And you might say with the VIX, well, it's been through the 16 to 18 level a couple times this year. It will probably get back there. So I'm going to look at it around 13. I'm going to say it's a buy. I know with UVXY that it's slowly going to decay. And so if I don't get that move to 16 sometime in the next while, whether it be a couple weeks, maybe even you could survive a month or two, then I'm going to end up losing. The good thing about if you decide to buy UVXY is that your losses, if your risk to the downside is more likely slow. It's a slow loss against you. It's a dribbling loss against you. Whereas if you were to short UVXY, your risk is a huge, big spike that just happens out of nowhere at some point. So, do you feel better with having the odds in your favor, but the chance of waking up to a huge spike that's very dramatically affecting your P&L, or do you feel more comfortable, well, I'm slowly bleeding every day, and the chances are I'm going to lose money, but at any moment, there could be a big spike, and I could make a ton just out of the blue. I know that it's very seductive for people, that idea of, I'm long this thing, and it's costing me a little bit every day, but when, something big happens in the market, I'm going to make out like a king and I can make a fortune. That is the seductive lure of UVXY, and that is why people buy it. I sort of make the case a lot for the sell side, although I don't feel like my job is to make a case for either side. My job is just to kind of explain how it works to you. And just from that vein, I had a couple questions come up. People write me on Twitter and other places with questions, so I want to read one of those here to you right now. And this has to do with UVXY. I'll pull up my Twitter really quick here, and we'll take a look. All right. And it's funny, I get on Twitter. I'm sure I'm not the only one to get these fake girl Twitter followers who are like, it's a beautiful woman, and she's like, hey, how you doing? And then you look, and the only people that are on her friends list are like, quote unquote, ugly guys. She has no girlfriends. It's just all like middle-aged men. And you're like, maybe this is a fake account. That's what it seemed like. This person that just reached out to me, it seemed like they came from that kind of a spot. It's kind of funny. Okay, so here's the question. Okay. Could you actually have a negative return? Hi, David. I really enjoyed your interview with Jay Wahlberg. I was wondering if you could elaborate yours and Jay's reluctance to trade vol during backwardation. Is the idea that positive roll between back months and front months or spot may be short short-lived, as spot may decrease to the extent that even if a forward curve goes into contact, you would actually have a negative return. I'm sure that sounds confusing to just listen to, but basically we were having a discussion about backwardation, and backwardation being when the futures are in such a way that the front month is at a higher price than the second month, which is at a higher price than the third month. So basically you have a chart where as the months go out, the prices of futures are lower, kind of meaning that you're at a spot where like the futures are saying that we're at a very high vol spot right now, and in the future it's going to be lower than where it is right now. And they, when we're in backwardation like that, when we have futures where the front month is higher than the second month, that means that as we rebalance ETFs, the ETFs move a little bit higher because we're selling something for a high price and buying something for a much lower price as far as the futures go. A, and B, a lot of times spot is above the futures, so all the futures are getting pulled up towards spot. And that creates a drag to the upside in like a UVXY. The point I was making was that I would short UVXY at that point. Now, the long-term effect of backwardation, if it stays in backwardation over a long period of time, is that the futures get pulled up towards spot and more so as you rebalance. However, what we find with backwardation is it usually is a very temporary circumstance, and it means that you're within a volatility spike. And generally, volatility spikes don't last very long. So the expectation is that spot price is going to move way lower. Instead of spot being above all the futures, it's going to be back below all the futures, and all of these VIX ETFs, including the VIX itself, are going to go way lower in a violent move lower very soon. Because generally, if you look at any spikes in the VIX, you see that they generally don't last very long, and they generally go way back lower than where they are in the middle of a spike really quickly. So the answer is the effects of the VIX just coming down rapidly after a spike are going to be greater, though that movement of the VIX violently moving downward is going to have more of an effect on UVXY or TVIX than the gradual effects of backwardation do. So that is why I would not really buy in general a VIX ETP in backwardation. However, there can be short-term trades, and you can feel that like, okay, well, vol spiking, but it's going to continue to spike higher short term, and you still might trade that short term as buying it. But in general, I'm generally more of a position trader that I'll put on a trade and I'll leave it for a while for it to work for me. And so in a case of backwardation, my likely trade would be to put on some sort of a short in UVXY during backwardation, with thinking that, well, I'll wait it out until the spike is over and things have calmed down again. And that can be one of the biggest opportunities, is to put a short on during a spike. You can ride it back down again from the spike. A lot of people focus on, well, I'm going to set up to be long this, so when the spike comes, I can make money. For me, I would rather be risk off until the spike comes and then ride it back down. That seems like a trade that I understand better. And this person also had another question for me, which I'm going to look to find here really quickly. And it had to do with the shape of, it had to do with a tweet that I sent the other day saying, okay, so this is the tweet I sent. I said, UVXY, contango still hovering around 7% with roll euro contracting to a still kind of wide $1.26. You can see how poorly this can make this perform on market down days as the term structure absorbs pops in the VIX. And this is a circumstance where we come into the day and the markets have been down. And however, UVXY was not up that much. It was up a teeny bit, but it was kind of sluggishly up. And the reason it being sluggishly up is because the term structure was so in contango, and it was after so many days of the VIX just being down and nothing happening, the term structure was in such a steep contango curve that any pop in the VIX cash just kind of flattened it out a little bit. It didn't create, it takes like extended few days of volatility to really get the term structure to flatten out and become, and to switch between contango and backwardation. There's a lot of give. Think of it as like having a car that had a really good springs on it, really good suspension. If you have a car that has really good suspension, it's going to take a big bump before you really feel it. And when you've got a situation where the VIX is in contango for a long period of time, and there's a lot of space between spot and the first future and second future, and you're in steep contango of like, let's say 10%, then it's like having a car with really good shock absorbers and really good suspension. When that bump comes, it's not really going to make UVXY get up and run. However, if you've been in a period of volatility where you have several days in a row of the VIX going up, then you get into a situation where like your suspension has taken all, it's given all it can give. It's the springs are pressed in all the way, and any move higher in the VIX is going to make UVXY really pop higher. And so his question was, what's your intuition behind why the term structure remains concave even in the event of blips in the spot? And my answer to that question is, first of all, well, it was concave, actually, the structure, which is interesting. The back months were actually, December was slightly lower than November, which made it look concave. And it really should just be upwardly sloping. The only reason it's concave is that December is generally thought of as a lower volatility month just due to the holidays being then, and it sometimes being a longer cycle, and many holidays during those weeks. So that's the reason why we're in a concave structure, just because the last month when you look at the term structure right now is December, and December they usually pull volatility down a little bit. But in general, it should just be an upwardly sloping curve. So concave is kind of an asterisk next to concave. We would just think of it being sharply in contango. And the reason why it stays so sharply in contango, even with a little blip, is because essentially the people that are trading the futures, this really doesn't concern, a little blip doesn't concern them in their sort of view of the market moving forward. That's all it is a little blip. There is no direct arbitrage between the VIX cash and the VIX futures. So the futures trade by themselves, and they trade many times just based on this sentiment of the people who are making markets in the futures. And so when you have just 1 or 2 down days, the people who are trading the futures and making markets in them, their sentiment doesn't change that much. And that's why the structure stays where it is, in my view. So let's talk for a second about market making and how that works. I know, there's feelings of the evil market makers who are, they're playing a rigged game. They know what's going to happen in the future, and they rip everybody off, and it's smoking, all the smoke and mirrors. And there's a little bit of that goes around in the world. I'm not as naive to think there isn't. However, having been a market maker for a long time, I can tell you that I was very often in the position where I certainly felt like I didn't know what was going to happen next. I felt like that there were bigger powers out there. It's like all the retail blames the market makers for everything happening. Us market makers, we blame the quote-unquote big guys upstairs who are moving the markets for everything. So how do you make markets in the future? Well, I said, these guys have this sentiment that makes it so the futures stay in the certain contango pricing that it is right now. If we dig a little bit deeper into that, I was taught to make markets based on price discovery. Price discovery means that you figure out what the price should be by, and it sounds simple and it sounds simplistic, but it's really the way it works, is that you find what the price should be by matching up the buyers and the sellers. So let's start with, you have somebody come in and he or she wants to buy the May future in the VIX. They're going to put a bid in, okay? Now, if we get, another buyer, they want to put a bid in too. Okay, so we know where the bid is, but we haven't discovered the price yet because all we have is a bid. So if there's a buyer, now I might make a market and I might say, okay, I'm 1450 bid at 1460. So if a guy comes in and says, I'll pay 1460, then I've made a market, so I will honor, some amount of contracts and I'll sell them for 1460, but then I'm going to move the market. And as being a market maker, I don't necessarily want to defend, as we call it, any particular price. Just because we're trading around 1460 right now, I want to discover what the price is for this. And all I have, if the only information I have is that someone's willing to pay 1460 to buy it, then I don't have enough information to discover what the actual value is, because the value could be way higher than 1460. That person could be getting quite a bargain. I need to have paper on the other side to tell me what the market is. So I know the market is 1460 bid now. I've sold a couple at 1460. I'm going to go higher. And, based on your experience, you might fade faster or you might fade slower, but I'm going to keep moving the price higher until somebody comes in on the other, who's a seller that's not me, but some order comes in to sell them. So I trade 1460, it moves higher. Somebody pays I make my market at 1480, let's say. And I'm just throwing out numbers here to illustrate the concept here. So someone pays 1480, all right? So I sell a teeny bit and I move higher. I'm going to keep moving higher until I get sellers coming in that put orders in to sell. And it doesn't matter what the price is. I'm going to keep moving it higher until I get those sellers in. That's what price discovery. Price discovery is that me as a market maker, I'm not really setting the price at all. I'm just letting the paper and order flow, I'm just getting out of the way so the paper and order flow can find its balance. So I raise the price until I get sellers coming in the other side that are willing to sell it. And if I can get sellers coming in the other side, then I will lower the price a little bit. And then once buyers meet sellers, then I know that's the market. But it's not because I made the market. It's because I'm letting the paper dictate and find its equilibrium level. That's what price discovery is all about. Now, I might have my own ulterior motives, which could be that I might be long these things, right? If I'm long them, I'm going to try to take the price up as high as I can, and then I'm going to sell them at a price that I think is a good price for them. If I'm short them, then I might be looking to either buy them back quickly and get out of my short right away, or I might, want to be a little bit resistant to try to influence things to go lower so that I can make money off my short in a way. So there are smoke and mirrors that market makers use, and a market maker may try to disguise what he knows about what orders he has in his book, for example. So, for example, a market maker might know that every day these guys come in and they have to sell 1 month and buy another 5,000 times. And so the market maker might, this big order that comes in every day for a 5,000 lot calendar spread, they want to make sure that the prices are as advantageous for that as possible, and they want to make sure that their position on those 2 months is the right one to take advantage of that order that comes in every day. So you might be moving prices around a little bit and making trades to set your book up for that order. And you may be willing to take down a trade that's a loser for you, that's small, to set yourself up the right way for that one big winner. So there's a lot of stuff that's going on in making all these markets. We know the size of something like UVXY or TVIX, and we know that these have to make some sort of roll every day. Some of them will use swaps, but we still know that even with swaps, it has to somehow be reflected in the market. The risk has to go somewhere. Now, when you have leveraged funds, and let's take a different example of, a lot of times you'll have leveraged funds. You'll have a long leveraged fund and a short leveraged fund. Now, if both of those funds are administered by the same company, then they're going to cancel each other out. And so when they're not going to have to rebalance as often, because if one fund has 500 million under management and the other has 400 million under management, then it's only that 100 million that they're going to have to trade every day in and out of. But if you have one long and one short fund in your portfolio, they're going to cancel each other out largely. That's one of the reasons why you do that and have those two funds. But this is a complex game, the VIX futures, and there's many players in it. However, if you make markets and you specialize in just trading these futures, you're going to learn over time who the players are, and you're going to have a better sense of what's actually going on. And you may be monitoring things like, the VIX being a derivative of the SPX. If a big order takes place in the SPX, then you're going to need to know about that, because that is going to affect your markets in this product. You'll find with the VIX that all these products are related. The same guy that makes markets in the VIX options is probably making markets in the UVXY options and SVXY options at the same time, and maybe even in SPX options. So all this stuff is related, and thus making a market is it relies on more things than price discovery, but it's definitely not a thing where, these guys are just cleaning up, making tons of money all the time. No, it's something that's very difficult to do. This is a very competitive environment, and nobody is just cleaning up, making easy money. Because if they were, then someone steps in and cuts that easy money out, makes the markets tighter, or competes with them until that easy money's gone. So it's always a quest for an edge, and that's what creates efficiency in the marketplaces. And these items are not largely inefficient. The places where it seems like they're largely inefficient is due to a lack of liquidity. And the only way that you can actually make markets in something when there's no liquidity is to widen out the markets. Because if the people that are making markets in these things lose money constantly, then they go out of business, and there's less players, and the markets widen out. That's just the way liquidity works. There's only so much. There's only so many people, so many players out there willing to take so much risk, and that level of risk taking. It doesn't matter how many products you bring into the market. That level of risk that people are willing to take has a limit, and that determines sort of the liquidity and the pricing of these different products. All right, so we've gone to about 44 minutes right now. I was watching my local national public radio, and this is their pledge drive week, and it's a pain in the neck listening to these people all day asking you. They're like, if you give $10, then you get a free like earbuds or something like that. But it does remind me that unlike a lot of the big players out there that I'm sure you might watch, like HBO or Netflix, all these big companies out there. Unlike those companies, I have one advertiser who is Guerrilla Trades. You should definitely check them out. And they offer a great product. I don't have all that many viewers, and so I'm able to send some viewers their way, which I know that they like, and it's a good deal for everybody around, because Guerrilla Trades are these experts at picking stocks, and they've done exceptionally well this year, especially with the rally. But check them out. But the only way I'm supported right now is through Patreon. And Patreon is a service that allows you to pledge like $1 or $5 on your credit card every month, and then that goes to supporting the channel here. So I'm here to ask you to go ahead and do support the channel. I've been experimenting with different people to help me with behind the camera so that I can have interviews, and I have some interviews, actually in-person interviews, scheduled for this summer. But all that stuff costs money, and it's, time is money in these days too. And I have a few side jobs, but if just a small, if you could just go in and give $5, I'm sure it would help me out a huge amount, because I don't have that much support on Patreon. And if this is something that's valuable to you, then it would be great if you could support the show. I need your support so I can bring you more and more quality content. I've got all these people lined up to interview, and I've got all these ideas, but I want to get more equipment, more video equipment. I need to get a better camera and a bunch of equipment to keep things rolling here. I really love doing the show, and it's what I want to do, and I want it to be a success. So help me out to make the show a success by supporting me on Patreon. If everybody just does a little bit, then it goes a huge long way. And I really do appreciate the people that do help me now on Patreon. You guys have been great, and I know some people, they'll help me for a few months, and then, they'll move on to something else, and that is, that's fine. I appreciate everybody who has signed on, even if it was just once. Even some people will give me they'll go into the chat in YouTube, and they'll leave a little message on the chat, a super chat with like $5 or something, and I appreciate that too. I want to, let's see, how am I going to do this? I want to read some of these patrons without, there we go. This way I can read some of the patrons. I don't want to actually publicize their names because it's kind of private, but I want to thank all these people for helping me out, because I really do appreciate you. Please, if you haven't done so yet, support the show. I can make it better that way, but I want to thank Abraham, and I want to thank Alex a lot. I want to thank Brent. I want to thank Bryony, who I'm smiling because that's my sister. I want to thank my sister for supporting me on Patreon. Thanks, Bryony. Dave Sherman, thank you. Other Dave, thank you. Thanks, Eric. Thanks, Hugh Evans. Hugh, I should say. Sorry, Hugh. Thanks, Jane. Thank you, Jorge. Let's see who else we have. Thanks, Kevin. Thanks, Luis. Thanks, Mike Kaiser and Mike K. And Mike K, thank you for all of your support for the Facebook group. I appreciate you having supported and helped us out as a moderator. Thanks, everybody. Give a hand to Mike K. And thanks, Clinton, also for helping with that. Thank you, Peter. Thanks, Robert. And thanks, Seth. You guys are great. And I really appreciate you. Please consider giving on Patreon. You will receive some benefits extra. I generally release the interviews ahead of time on there. I will respond more quickly to your emails or any requests you have. I'm willing to discuss anything you'd like me to as far as trading and whatnot. You know, as I get bigger, it becomes harder to respond to everybody's requests. It's just it gets overwhelming sometimes, the emails and stuff. So, you know, your priority if you're a Patreon supporter. And it's not it's not like I'm like cleaning up or anything. But it all goes to equipment and scheduling and other things to do with the show. So thank you so much for all of you. Please consider supporting on Patreon, and I'll be back next time with a short vol show live. I want to discuss next time coming up some strategies of how to trade UVXY even when we're in a down market like this. I want to discuss some strategies where you're going to collect decay as you hang out as we move lower. So we'll talk about that next time on the Short Vol Show Live. Thanks for watching, everybody, and thank you for your support.